Imagine this. You're a proud parent. Maybe you just set up a small investment account for your child, dreaming of college funds, maybe a down payment on a first home someday. You're feeling good about giving them a solid financial start.
Absolutely, that's a great goal.
But then this question pops up that, well, it can frankly send a shiver down your spine.
Ah.
How does that money, especially the investment income, actually get taxed? Because, it's not just simple pocket money anymore, is it?
That's exactly right. Once those earnings move beyond, say, allowances or maybe a few bucks from mowing lawns and into the world of interest, dividends, capital gains, well, the tax picture changes quite dramatically.
Well, it's not just about their summer job earnings anymore.
Not at all.
And that's precisely why we're doing a deep dive today.
Mm.
We're looking into a very specific, and let's be honest, often misunderstood part of U.S. tax law.
Mm-hmm.
People usually call it the kiddie tax.
Mm-hmm. The kiddie tax.
And this isn't about how much your kid earns babysitting. It's really about the intricate rules for figuring out and taxing a child's investment income and other kinds of unearned income.
So our mission today really is to unpack all those complexities surrounding a child's unearned income. We want to clarify, exactly who gets affected by these rules, what kinds of income we're actually talking about, and probably most importantly, the different ways this income can end up being taxed.
Okay.
And we'll definitely highlight the potential upsides, the benefits, but also the drawbacks of the different approaches. The goal is to help you understand where you might optimize things for tax efficiency for your family.
Got it. And to do that, we'll be digging into some official IRS stuff, the instructions and the forms themselves, specifically Form 86-Funyuman, Form 8814, and we'll even touch on Form 8960, which is about the net investment income tax.
Right. See how it all connects.
Exactly. We want to get right to the heart of what you really need to know. Okay, so let's unpack this, starting with the big one. What is the kiddie tax fundamentally, and who does it actually affect? Because I have a feeling the term child in tax law isn't quite as simple as someone under 18.
You're absolutely right. That's the critical starting point. For tax purposes, the definition of a child who's subject to these rules, while it has very specific age criteria, generally, yes, a child is covered if they are under age 18 at the end of the tax year.
Okay, so for 2024 taxes, that means under 18 on December 31st, 2024. Seems clear enough.
It does, but it doesn't stop there.
Ah, okay. What if they just turned 18 during the year? Are they automatically off the hook?
Not necessarily, no. The rules actually extend beyond that simple cutoff. A child is also generally subject to the kiddie tax if they're age 18 at the end of 2024, and this is key, their earned income wasn't more than half of their total support for the year.
Earned income. Okay, we'll need to define that clearly soon. So 18-year-olds might still be included if they aren't supporting themselves much through work.
Exactly. And maybe surprisingly, it can even apply to older students. So if your child was a full-time student and they were at least 19 but under age 24 at the end of 2024,
okay,
and again, their earned income was not more than half of their total support, they could also be subject to these kiddie tax rules.
Yeah, okay. So it's really not just a strict age limit. It's factoring in their dependency level, essentially, how much they're supporting themselves through actual work.
That's a good way to think about it, yes. Financial independence plays a role.
Okay, before we go further, you said earned income and unearned income a few times now. Let's pause and really nail those down, because that distinction seems absolutely fundamental to understanding this whole kiddie tax thing.
Good idea. Let's get that clear right now. Earned income is, well, basically income you get from personal services. Think salary from a summer job, wages from working at a store part-time, maybe tips from waiting tables.
Right, money they worked for directly.
Exactly. Capital, like investments, is not the main thing producing the income. Now, unearned income, which is our primary focus here for the kiddie tax, that includes things like interest from a savings account, ordinary dividends from stocks they might own, capital gain distributions from mutual funds.
Okay.
Maybe even rent if the child somehow owns a rental property.
Yeah.
It's income that isn't generated by their own labor or services.
Got it. Wages earned, investment returns unearned. Simple enough on the surface. But are there any, weird details or common mistakes people make here, even once they get that basic difference? Things that catch people off guard.
Oh, definitely. There's a fascinating little quirk with birthdays that can absolutely trip people up. This is where tax law gets interesting.
Uh-oh. Okay, what is it?
So the IRS has this table. It's in the instructions for Form 86 one time called Certain January 1 Birthdays. And basically for these tax rules, if your child's birthday happens to be January 1st,
Yeah.
the IRS treats them as if they turned that age on December 31st of the previous year.
Wait, really? So they age up a year earlier for tax purposes.
Effectively, yes, for these specific rules. So let's say a child was born on January 1st, 2007. For kiddie tax purposes, at the end of 2024, they're considered to be 18, not 17.
Wow. Okay, so that could push them right into that age 18, but earned income less than half support category a year sooner than the parent might expect. That's a huge detail.
It really is. It can completely change whether the rules apply or how they apply. And similarly, someone born January 1st, 2001 would be considered 24 at the end of 2024.
Meaning they're definitely aged out, right? Form 8615 wouldn't apply then.
Correct. They'd be beyond the age criteria for full-time students. It just shows you how incredibly specific these rules can get.
No kidding. Okay. Besides age, earned income levels, and this weird birthday rule, are there any other conditions for falling under the kiddie tax umbrella?
Yes, a couple other important ones. At least one of the child's parents must be alive at the end of the tax year. If, sadly, both parents passed away during the year, the kiddie tax rules don't apply for that year.
Okay, that makes sense.
Also, the child cannot file a joint tax return for the year, say, if they got married themselves.
Right. And does it matter if the child is technically a dependent
Hmm.
or who the parent is?
That's another good point. The definition of child here is quite broad. It includes legally adopted children, stepchildren, and critically, these rules can apply regardless of whether the child can be claimed as a dependent on someone else's tax return.
So even if they aren't your dependent, if they meet the age and income criteria and you're their parent, these rules could still apply to their unearned income.
That's correct. The dependency status doesn't determine if the kiddie tax applies, although it often overlaps.
Okay, that definitely broadens the scope. Right, so we've got a pretty clear picture now of who might be considered a child for these rules. Let's circle back to the what. What specifically counts as unearned income for these calculations? You mentioned interest, dividends, capital gains, anything else? And maybe more importantly, what doesn't count?
Okay, so generally it's that passive type income, interest, ordinary dividends, capital gain distributions, annuities, royalties, rent, basically gross income that isn't from personal services. But, and this is really crucial, unearned income for this purpose only includes amounts your child must include in their gross income, meaning non-taxable unearned income is out. So things like tax-exempt interest, maybe from municipal bonds, or the parts of Social Security payments or pension payments that aren't taxable, those are explicitly not included in the unearned income amount used for the kiddie tax calculation.
That's a really valuable point for planning. So if a family invests heavily in municipal bonds for their child, that specific income stream won't trigger or inflate the kiddie tax.
Exactly. It's only about the taxable unearned income.
Got it. Okay, so we know the who, the child definition, and the what, taxable unearned income. Let's tackle the why. Why does this whole kiddie tax thing even exist? It feels like, an extra layer of hassle for parents and kids.
That's a fair question. It definitely adds complexity. Historically, the kiddie tax came about, I believe it was back in 1986, to stop a specific kind of tax avoidance strategy.
Okay, what was the strategy?
Before the kiddie tax, some parents, especially those in higher tax brackets, would shift their investment assets, things that generate income like stocks or bonds, into their children's names.
I think I see where this is going.
Right. The kids, usually having little or no other income, would be in a much lower tax bracket, maybe even the 0% bracket, so that investment income would be taxed at a much lower rate, or maybe not at all.
So the family as a whole paid less tax on that same investment income than if the parents had just kept it in their own names.
Precisely. It was a way to use the child's lower tax bracket to reduce the family's overall tax bill. The kiddie tax was designed specifically to close that loophole. It aims to prevent parents from just shifting investment income to kids solely to avoid higher parental tax rates.
So it's fundamentally an anti-income shifting rule, trying to make sure investment income gets taxed appropriately based on the family's means, roughly speaking.
That's a really good way to put it, yes. And the core mechanism, the way it achieves this, is by stipulating that a child's unearned income above certain thresholds gets taxed not at the child's rate, but at the parent's marginal income tax rate.
Up there on its higher rate, usually.
Typically, yes.
Yeah.
That's the whole idea behind Form 8615, which actually does that calculation. It effectively eliminates most of the tax benefit you'd get from shifting that income to a child's lower bracket.
Okay, the why is clear, now preventing that specific tax avoidance. So now that we have the basics, who's affected, what income counts, why it exists, let's get practical. How is this income actually reported and taxed? Because, as you hinted, There seems to be a choice for parents, a kind of fork in the road.
Yes, absolutely.
And understanding this choice, these two main ways to handle a child's unearned income, feels like it could be a real aha moment for our listeners. It could directly impact your family's bottom line, right?
It absolutely can. This decision point is crucial and can significantly change the overall tax paid by the family. Parents generally have two main options when their child has unearned income that falls under these kiddie tax rules.
All right, let's break them down. Option one, the child files their own tax return. And if they meet the criteria, they attach Form 8614, which is officially called Computation of Tax for Certain Children Who Have Investment Income. When is this the path you have to take?
Okay, so Form 8615 comes into play if the child's unearned income is above a certain amount and the parent doesn't or maybe can't make the election to report it on the parent's return. For the 2024 tax year, that threshold where you start needing to think about Form 8615 is generally if a child's total unearned income is more than $2,600.
$2,600 of unearned income.
Okay, but there's also a harder limit related to their total income. If the child's gross income that's earned plus unearned hits $13,000 or more for 2024,
Yeah.
then the other option, using Form 8814 on the parent's return, is completely off the table. The child must file their own return in that case. And if their unearned income is also over that $2,600 threshold, they'll need to include Form 8615 with their return.
Okay, so $13,000 in total gross income is a key number. Below that, parents might have a choice. Above that, the child has to file their own return. That's a really important distinction.
Very important.
Now, let's talk about actually filling out Form 8615. It looks, well, a bit intimidating. Can we walk through the main steps, the principles behind the calculation?
Sure. It might look complex, but it follows a logical sequence. The first major step on Form 8615 is figuring out the child's net unearned income. This is basically the amount that might get taxed at the parent's rate.
How do you calculate that?
You start with the child's total taxable unearned income, the interest, dividends, etc. that we talked about. Then you get to subtract some amounts. The main one is a portion of the child's standard deduction.
Ah, the standard deduction. So the child still gets some benefit from that, even under the kiddie tax.
Yes, that's right. A part of their unearned income is sheltered by their own standard deduction. For 2024, the rules generally allow the child to shield $1,300 of unearned income with their standard deduction. There's another $1,300 threshold as well. So the first $1,300 is usually tax-free due to the standard deduction. The next $1,300 is taxed at the child's rate, and anything above $2,600 is potentially taxed at the parent's rate.
Okay, so that $1,300 plus $1,300 makes sense now. It's the point where the parent's rate potentially kicks in.
Exactly. But there used to be another potential deduction. People might remember those directly connected itemized deductions, things like investment fees. Are those still helpful?
That's a really critical point. Something that changed significantly a few years back and affects taxes right now. For the tax years 2018 all the way through 2025, due to the Tax Cuts and Jobs Act,
Right.
those miscellaneous itemized deductions, the ones subject to the 2% floor previously, are suspended. They're simply not deductible.
And that category includes many expenses that you might think are directly connected to producing unearned income, like investment advisory fees, custodian fees for a brokerage account, service charges for collecting interest or dividends.
So even if you pay those fees specifically for the child's investment account, you can't deduct them on the child's return during these years.
Correct. They are not deductible right now. So while older instructions or articles might mention them, for current filings through 2025, they don't reduce the child's taxable income. This effectively means less shielding of that unearned income, which could mean more of it gets taxed, potentially at the parent's higher rate.
That is a huge change that could definitely catch people off guard and lead to a higher tax than expected.
Okay, so once we've figured out that net unearned income, the amount potentially subject to the parent's rate, how do we figure out which parent's rate to use? This must get complicated if the parents aren't just married filing jointly. You're absolutely right. Determining the correct parent's rate is often one of the trickiest parts. The goal is always to use the tax rate schedule of the parent who would likely have the higher tax liability, essentially reflecting the income shifting prevention goal.
Okay, so married filing jointly is easy.
Yes, if the child's parents are married and file a joint return, you just use the income and tax rates from that joint return. Simple.
But what about, say, divorced parents or parents who never married?
Okay, this is where it gets more detailed. If the parents are divorced or legally separated, you generally use the return of the custodial parent, the one the child lived with for the greater part of the year.
What if the custodial parent remarried?
Good question. If the custodial parent has remarried, Their new spouse, the child's step-parent, is treated as the child's other parent for these rules. So if the custodial parent and the step-parent file a joint return, you use that joint return. You wouldn't use the non-custodial parent's return in that situation.
Okay, so the step-parent's income now factors in. What if the remarried custodial parent and step-parent file separately?
Then you use the return of the one custodial parent or step-parent who has the higher taxable income.
Always going for the higher income parent's rate.
Generally, yes. And similar logic applies if the parents were never married but lived together all year. You use the return of the parent with the greater taxable income. If they didn't live together all year, you follow the rules as if they were divorced, focusing on the custodial parent.
It sounds like getting that parent's tax information, their filing status, their taxable income, could be a real headache sometimes, especially in non-traditional family structures or if relations are strained. What if the child just can't get that info by the tax deadline?
That's a very real problem, and the IRS does have procedures. If the parent's information isn't available by the child's filing deadline, the first step should usually be to file for an extension using Form 4868.
Okay, buy some time.
Exactly, but remember, that's an extension to file, not an extension to pay. Taxes still technically due. If, after making reasonable efforts, the child genuinely can't get the parent's information, they or their representative can actually send a signed written request directly to the IRS.
Asking the IRS for help.
Yes. The request needs to explain they're trying to comply with the kiddie tax rules, Section 1G of the tax code, include proof of the child's age, like a birth certificate copy, and evidence they tried to get the info from the parent. The IRS might then provide the necessary tax information from the parent's return or potentially estimate it. It's a last resort, really.
Wow, that's quite a process. Okay, assuming you do have the correct parent's tax information, how does Form 8619 actually use it to calculate the tax at the parent's rate on the child's net unearned income?
Conceptually, what happens is that the child's net unearned income is sort of temporarily added to the parent's taxable income to figure out what tax rate applies to that specific slice of income. It doesn't actually change the parent's tax liability, but it determines the rate for the child's income.
So it finds the marginal rate.
Exactly. It finds the parent's marginal tax rate, the rate their next dollar of income would be taxed at, and applies that rate to the child's net unearned income. This often involves using special worksheets, especially if the child has qualified dividends or capital gains, because those have their own preferential rates. The worksheets make sure those preferential rates are applied correctly, but based on where they'd fall within the parent's income structure.
So it's not just applying a single percentage. It's really integrating the child's income characteristics into the parent's tax bracket calculations to find the right rate.
Precisely. It mirrors the parent's tax situation for that income. Then, the form calculates the tax on the rest of the child's income, their earned income, plus that first $1,300 of unearned income taxed at the child's rate using the child's own filing status and tax brackets.
Okay, so part taxed at parent's rate, part at child's rate. How does Form 8614 pull it all together for the final tax number on the child's return?
It basically does two main calculations. First, it adds together the tax calculated at the parent's rate on the net unearned income and the tax calculated at the child's rate on the rest of their taxable income. Let's call that calculation A.
Okay.
Then it does a second calculation. What would the tax be on the child's total taxable income if we just used the child's own rates entirely, as if the kiddie tax rules didn't exist at all? Let's call that calculation B.
Right, a baseline using only the child's situation.
Exactly. The final tax amount that goes on the child's tax return, Form 1040, is the larger of calculation A and calculation B.
Ah, so it ensures the kiddie tax is applied only if it actually results in a higher tax, fulfilling its purpose of preventing the tax benefit from income shifting.
You got it. That's the logic. It guarantees the higher tax applies when the kiddie tax rules are triggered.
Okay, that clarifies Form 8615 quite a bit. Now let's switch gears to option 2. This is the one that, at least on the surface, seems much simpler. Parents electing to report the child's interest and dividends directly on their own tax return. This uses Form 8814, parents' election to report child's interest and dividends. What's the main appeal here?
The main appeal is absolutely simplification, convenience. If parents are eligible and choose to use Form 8814, the child typically doesn't have to file their own separate tax return at all. No need for the child to deal with Form 1040 or Form 8615.
I can see why that's tempting.
Definitely. The parents just complete Form 8814 and attach it to their own Form 1040. The child's income gets included, taxed, and paid with the parent's return. For busy parents, especially with younger children who only have some interest or dividends, it seems like a much easier path.
It really does sound convenient. But like most things in tax, there have to be strings attached, right? What are the specific eligibility rules? It surely can't be available for every situation.
Absolutely correct. There are very strict criteria you have to meet to even make the selection. First, the child's income for the year must only be from interest, ordinary dividends, which includes qualified dividends, and capital gain distributions. Nothing else.
No earned income, no other types of investment income.
Correct. Only those specific types. Second, the total gross income from those sources must be less than $13,000 for the 2024 tax year.
There's that $13,000 number again. So if they have $13,000 or more, even if it's only interest and dividends, Form 8814 is out.
Exactly. At $13,000 or more, the child must file their own return. Other rules. No estimated tax payments can have been made for the child under their name and social security number for the year. No federal income tax can have been withheld from the child's income, like through backup withholding.
Okay.
Also, the child can't have an overpayment from the previous year applied to the current year's tax. They must not be subject to backup withholding. And as before, the child cannot file a joint return.
So quite a few hurdles. If they had tax withheld or made an estimated payment or have any income other than basic interest, dividends, capital gain distributions, or make too much, Form 8814 is a no-go.
Precisely. The instructions are very clear. It's designed for relatively simple situations. There's also that $2,600 threshold again. If the child's income from these sources is $2,600 or less, the calculation on Form 8814 is simpler, but you still make the election if you want the income on the parent's return. If it's over $2,600 but less than $13,000, the calculation is a bit more involved but still possible.
Right. This brings us, though, to what feels like the most critical part of this whole discussion, the tax-benefit trade-off. You mentioned it earlier, and Form 8814 itself has this very prominent caution right here at the top. Can you unpack that warning for us? Because this is where the convenience factor might really cost people money.
Absolutely. This is, I think, the single most important takeaway for anyone considering Form 8814. The form literally says, and I'm quoting loosely here, caution, the federal income tax on your child's income may be less if you file a separate tax return for the child instead of making this election.
Whoa.
And it goes on to explain why. This is because you cannot take certain tax benefits that your child could take on his or her own return.
That's the IRS basically waving a red flag saying, hey, this easy way might cost you more.
So what are these specific lost benefits the child gives up when the parents choose Form 8814? Can you give us a practical example of how this plays out financially?
The biggest lost benefit, the one that usually makes the most difference, is the child's own standard deduction applied against their unearned income. Remember how we said on Form 8615, the child gets to shield the first $1,300 of unearned income with their standard deduction, and the next $1,300 is taxed at their typically low rate.
Yeah, that first $2,600 gets favorable treatment on the child's return. Exactly. But when the parents make the Form 8814 election, that child's income essentially gets plopped directly onto the parent's tax return. It gets added to the parent's other income. And while there's a small adjustment on Form 8814 itself, the child doesn't get the full benefit of applying their own standard deduction against that income in the same way they would on their own return.
So less of the income is shielded from tax at the outset.
Correct. More of it becomes subject to tax, and crucially, it's subject to tax at the parent's marginal tax rate, which is usually higher than the child's rate, especially for that second $1,300 slice.
Okay, let's try that hypothetical again to make it concrete. Say the child has $5,000 in dividends, no other income. Parents are in the 24% bracket if the child files their own return with Form 8615.
Right. On Form 8615, the first $1,300 is covered by the standard deduction. Tax is $0. The next $1,300 is taxed at the child's rate, which might be 10%. Tax is $130. The remaining amount, $5,000, $1,300, $2,400, is the net unearned income tax at the parent's 24% rate. Tax is $576. So the total tax on the child's return would be $0 plus $130 plus $576 plus $706.
Okay, $706 is total tax if the child files separately, using Form 8615. Now, what if the parents use Form 8814 instead, for convenience?
If they elect Form 8814, the calculation is different. The form essentially taxes the first $1,300 at 0%. The next $1,300 is taxed at 10%. That part is similar, so $130 tax. But the amount over $2,600, which is $5,000, $2,600 is $2,400 gets added to the parent's income on the Form 1040.
And taxed at their 24% rate.
Yes. So that $2,400 adds $576 to the parent's tax bill, $276.24. The total tax impact from using Form 8814 is $130 from the form itself, plus $576 added to the parent's tax equals $706.
Okay, in this specific simplified example using those rates, the total tax came out the same. Let me rethink the typical disadvantage.
Ah, interesting. Maybe the disadvantage isn't always there, or depends on the brackets. Let's reconsider the Form 8814 calculation slightly. The form does calculate tax on the income between $1,300 and $2,600 at 10%. The income above $2,600 is added to the parent's income. The real disadvantage often comes because adding that income to the parent's return might push the parent's other income into a higher bracket, or it could affect phase-outs for other credits and deductions the parents are taking.
Okay, so it's not just the tax on the child's income itself, but the ripple effect it has on the parent's overall tax return.
Exactly. That $2,400 added to the parent's income increases their adjusted gross income, AGI. A higher AGI can reduce eligibility for things like, say, education credits, the child tax credit for other children, maybe certain itemized deductions that have AGI limitations, or even impact IRA contribution deductibility. The $706 tax calculated might be the same in that simple scenario, but the total tax increase for the family could be higher due to these secondary effects on the parent's return.
That makes much more sense. The convenience of Form 8814 might hide these less obvious costs that only show up when you look at the parent's complete tax picture. That's the real caution, perhaps.
Precisely. You have to look at the overall impact on the family's tax liability, considering all the credits and deductions on the parent's return. Running the numbers both ways, child filing separately versus parent electing Form 8814, is often the only way to know for sure, which results in less total tax for the family.
So the takeaway is clear. Don't just assume Form 8814 is better because it seems easier. The convenience might cost you real money, especially due to those ripple effects on the parent's AGI. A crucial point for you, our listener, to really think about.
Definitely run the comparison.
Okay, we've gone deep into the kiddie tax itself and the two main reporting options. But you mentioned earlier another layer of tax that could potentially interact here, especially for higher income families. That's the net investment income tax, or NIIT.
That's right. The NIT, which is calculated on Form 8960, it's important to understand this is a separate tax. It's in addition to the regular income tax we've been discussing. It's not a replacement.
Yet specifically on adjustment income?
Yes, it's a 3.8% tax levied on the lesser of your net investment income or the amount your modified adjusted gross income, MAGI, exceeds certain thresholds. So again, it's targeted. It's definitely not a tax benefit. It's a potential extra cost.
Okay, who exactly has to worry about this NIIT? Is it everyone with investments?
No, not at all. For individuals, it primarily applies to U.S. citizens and residents, but only if they have both net investment income and their modified adjusted gross income, MAGI, is over the applicable threshold for their filing status.
What are those thresholds?
For 2024, the MGI thresholds are $250,000 for married filing jointly or qualifying surviving spouses, $125,000 for married filing separately, and $200,000 for single filers or those filing as head of household.
So you need fairly substantial income before NIIT even becomes a possibility.
Correct. Below those MEGI levels, you generally don't need to worry about NIIT even if you have investment income.
And what about estates and trusts? Can they be subject to it?
Yes, estates and trusts can also be subject to NIIT if they have undistributed net investment income and their adjusted gross income, AGI, exceeds the threshold for the highest tax bracket applicable to estates and trusts. It's worth noting that non-resident aliens are generally not subject to NIIT.
Okay, targeted at higher earners and certain entities. Now, what exactly counts as net investment income for this tax? Is it the same definition as the unearned income for the kiddie tax?
It's similar in some ways, but also has specific nuances for NIIT. Generally, net investment income for NIIT includes gross income from things like interest, dividends, annuities, royalties, and rents, unless that income is derived in the ordinary course of an active trade or business.
Okay, so passive income mainly, but with an exception for active businesses.
Right. There are exceptions for passive activities, too, and for trading businesses. It also includes net gains from selling property, like stocks, bonds, or investment real estate, again, unless that property was used in an active, non-passive trade or business. This gross investment income is then reduced by certain deductions that are properly allocable to it, like investment interest expense or investment advisory fees. which, interestingly, are potentially deductible against investment income for NIT purposes, unlike for regular tax under the current suspension of miscellaneous deductions.
Ah, another complexity. So some deductions might be allowed for NIT even if not for regular income tax right now.
Potentially, yes. It adds another layer.
What about income that is definitely excluded from NIT? What doesn't get hit by this 3.8% tax?
There's a clear list of exclusions. Things like wages, unemployment compensation, operating income from a non-passive business, Social Security benefits, alimony, tax-exempt interest, like from municipal bonds, distributions from most qualified retirement plans, like 401ks and traditional IRAs, and income subject to self-employment taxes are generally not considered net investment income for NIIT purposes.
Got it. Good exclusions to know. So now let's connect the dots. How does this NIT potentially link back to the child's unearned income and the kiddie tax rules we discussed? Does the child's income somehow trigger NIT for the child, or is the connection somewhere else?
This is where the choice between Form 8615 and Form 8814 becomes relevant again, particularly for parents who might be near or above those NIT income thresholds. The connection happens specifically if the parents choose the convenience route using Form 8814 to report the child's interest and dividends on their own return.
Okay. How does that link?
The instructions for Form 8960, the NIIT form, specifically state that the taxable interest and dividend income from Form 8814, specifically the amount calculated on line 12, Form 8814, can be included as part of the parent's net investment income calculation for NIIT purposes. It gets added on line 7 of Form 8960, which is for other modifications to investment income.
Wait, so let me make sure I understand this. By choosing Form 8814 to simplify filing for the child, the parents might not only face a higher regular income tax due to lost deductions and AGI effects, but they could also end up paying the additional 3.8% IIT on that same child's income if the parent's own AGI is over the NIIT threshold.
That is exactly the potential interaction, and yes, it could feel like a double hit for those higher income parents.
Wow, that makes the Form 8814 election seem even less appealing for families hovering around those $200 GO or 250K MAGI levels.
It's definitely a significant factor they need to consider. It's another potential and potentially costly consequence of choosing the simpler Form 8814 route. That income, reported on the parent's return, becomes part of their investment income pool subject to NIT.
It really highlights how interconnected these different parts of the tax code are, doesn't it? A choice made for kiddie tax reporting can directly impact liability for a completely different tax like NIIT.
It really does. Comprehensive tax planning isn't just about looking at one form in isolation. You have to see how the pieces fit together.
And just to be absolutely clear, if the child files their own return using Form 8615, their income generally wouldn't trigger NIIT for the child, right? Because the child's own NGI would almost certainly be below the $200,000 threshold for single filers.
That's almost always going to be the case, yes. It's highly unlikely that a child subject to kiddie tax rules would have enough total income to hit the individual NIT thresholds. So the NIT risk associated with the child's income really falls squarely on the parent's shoulders, and only if they make that Form 8814 election.
And remember, the NIIT is calculated separately. It's that extra 3.8% on top of the regular income tax determined via the kiddie tax rules, whether on Form 8615 or implicitly via Form 8814.
Correct. An additional layer.
Okay, this has been an incredibly detailed and I think really clarifying deep dive into the kiddie tax, its reporting options, and these surprising connections to things like NIT. Let's try to boil down the key takeaways for everyone listening.
Sounds good. I think the first main point is understanding there are two primary paths for handling a child's unearned income subject to these rules. Either the child files their own return, likely needing Form 8600 on the thumb.
Right, where their net unearned income gets taxed at the parent's rate.
Or path two, if eligible, the parents can elect to report the child's interest, dividends, and capital gain distributions on their own return using Form 8814.
And we hammered home the core kiddie tax concept itself. It exists to tax a child's significant unearned income at the parent's marginal rate to prevent families from just shifting investments to kids to get a lower tax rate.
We also stress understanding the key thresholds, knowing who qualifies as a child based on age and earned income support tests, the $2,600 unearned income level where kiddie tax often starts, and that $13,000 gross income limit for using Form 8814.
And maybe the most crucial practical point, that big caution on Form 8814. While it offers convenience, Electing to put the child's income on the parent's return can very possibly lead to a higher overall tax bill for the family.
Yes, primarily because you lose the full benefit of the child's standard deduction applied against that income, and potentially because it increases the parent's AGI, which can negatively impact other credits and deductions. Running the numbers both ways is key.
Plus, we added that extra wrinkle. For higher income parents potentially subject to the net investment income tax, making that Form 8814 election could also expose the child's investment income to the additional 3.8% IIT on the parent's return.
Absolutely. It just underscores that simplification and optimization are often not the same thing when it comes to tax planning.
Definitely. But being well informed about these nuances, understanding these trade-offs, really can save your family money and help you avoid those nasty surprise tax bills. It's about making smarter financial choices.
It truly is. Knowledge here translates directly into potentially keeping more of your child's investment earnings working for their future, rather than paying unnecessary taxes.
So as you think about your child's financial journey, maybe setting up those investment accounts, consider how these seemingly technical tax rules, the kiddie tax, the reporting choices, the NIIT link, could really shape the long-term growth of their wealth.
This brings up, I think, a really provocative thought for you to mull over.
For families focused on building maybe generational wealth or just giving their kids the best possible financial start, how should these complex rules influence not just how much you save or what you invest in for your child, but the actual structure and strategy for managing and reporting those assets over potentially decades? How can you navigate these rules year after year to truly optimize their financial trajectory within the bounds of the law? It's not just about this year's tax return, is it?
That's a fantastic point. It elevates the conversation from just annual compliance to long-term strategic planning. How you title assets, the types of investments chosen, taxable versus tax-exempt, managing income realization, and choosing the filing method year by year. It all plays a role in that bigger picture.
So we really encourage you, our listeners, to look closely at your own specific family situation. Definitely consult the latest official IRS instructions. We talked mainly about 2024 rules today, but thresholds and details can change.
And if your situation involves significant income, complex family structures, or you're just unsure after hearing all this, absolutely consider seeking advice from a qualified tax professional. They can help you run those comparisons and navigate these rules based on your unique circumstances. Personalized guidance is often invaluable here.
That's excellent advice. Well, that wraps up this deep dive into the world of the kiddie tax. We hope we've shed some light on this complex topic for you.
Thanks for tuning in.
We'll be back soon with another dive into the details that shape our financial world.